Well, I've checked and rechecked. I did the calculations and I've talked around. I've talked to those who are in the know. I talked to Dr. Nenner, and it looks like everything is pointing towards a recession, really, that you become aware of in the third quarter of this year. And the third quarter is very, very soon. We're talking probably 90 days. And that's not to say we're not already in a recession. It's just it's going to become very, very evident in 90 days. Now, in my calculations, I do an economic model calculations, and I do a timing model calculations. And a timing model is pinpointing third quarter for the last and final peak for housing prices for this cycle. And that after that, it rolls over to a correction. And that's not so much fun, but it just happens. There's nothing you and I can do about it, but we can be very aware. And if you're aware of it, it's going to present a absolutely outstanding opportunity for you to buy investment properties or a home for yourself. But you need to, raise cash and make sure that your income streams are in good shape. Make sure your credit's in good shape. And then when the timing is right, you're going to make a fortune. But in the meantime, it can be a pretty scary little deal. And I think what we're looking at here is probably a recession coming. I think it's going to be a fairly severe recession. It looks that way. What concerns me, of course, as we've talked about as ad infinitum, is the fact that there's no liquidity. That's all been drained. It continues to be drained out of the system. And liquidity is just like gasoline in your car. When that gasoline is gone, your car just stops. And that's what I think is going to happen with the economy. We're looking at a projection of third quarter. So literally, we're talking 90 days from now. We're going to know if we're right or wrong. I think we're in it already. I just think we're probably going to be much more aware of it. I don't want to dwell on this, but we're seeing liquidity keeps dropping, and as liquidity drops, we're seeing the producer price index drop along with it. Now, this is coming from May from Zero Hedge. I will have something a little later, but producer price index. We talked about that in November of 20. We hadn't seen inflation in almost a decade. And we saw inflation come into the producer price index. And I said inflation is coming. So now what we're talking about is that we see inflation coming out of the producer price index. So we see lower prices coming. I think it's funny that you should start seeing lower egg prices. Everybody's talking about lower eggs. You're going to see lower chicken prices, lower meat. So we are going to have deflation. And I think we're going to have lower home prices as well. So this is just a fleeting, it's not going to be very, very long. Our longer dated charts are still showing that we have some serious inflation coming on the outliers, but we'll deal with that in a little bit. But right at the moment, we see prices coming down. That's really, really good. And I'm going to tell you, when you have liquidity get drained like they're having in Turkey. Now, I like to pick on Turkey because it is so badly run. They have they're running 70, 80% inflation. They've destroyed their currency. It used to be in 2000, it was par 1 for 1. Now it's like 17 or 18 lira to the dollar. And of course, that means that it's 17 or 18 times what we would pay is what they pay. It's just been terrible. And of course, they are losing the liquidity. And this is going to bring their economy to a standstill. And that is something that we need to be concerned about because the US dollar, of course, is under attack. Now, here's the producer price index. I do want to take a look at this and just get a real good idea of this, is that we are actually seeing the US PPI is actually going negative for intermediate demand. So that's why I think we're going to start seeing, maybe we see some deflation coming along here, which is good and bad, but, it just tells us the indication where we're going. And I'll tell you that, we have signposts as we go along. And as we go along, you start seeing that things start becoming more of the same. Now, in a recession, always changes behavior. So we're seeing us driving less and consuming less gasoline. That's down. But on the other note is that we're consuming way more alcohol. So we're under stress and we want to we want to relax a little bit, and we're staying home more often, so we're consuming more alcohol. Just an interesting sideline. Now, in my asset class, I think if we get this cycle completion, we probably have a pretty severe correction right after it. Now, we've been talking about the fact that these corrections are regional in nature. Now, we have some really concern for cities around the country. Chicago certainly is one of them. Portland certainly is one of them. Seattle's a concern. We get to Milwaukee, St. Louis. These are places that people are leaving. And, you know, when these are regional prices, so we've talked about what is the price of a property no one wants? You know, what's the value of that property? So it's unfortunate is that when you're doing comparables, it means the last property sold is setting the price trend. Well, what happens when no one wants to buy the price? Nobody wants to buy the property. What happens to the price? Well, price just falls, and you can just get these vacuums and prices come down. And that's where we're heading, I think, because we're seeing a severe liquidity. So when you have severe liquidity, that means that you automatically have to know that underwriting is going to get to be very, very difficult. Now, if you don't have very much to lend out, you get to be very particular who you're going to send it to, and your standards start raising, and we're starting to see that as well. So let me go to my next slide, and let's just talk about that. Here's what's happening now. Now, this is where we're seeing lenders are really, really going to get hurt, and we've been talking about this. Now, this recession is going to be very, very similar to like the 1988 through the 1990 recession, where that was basically a commercial-led recession. Housing certainly did have problems, but the major problems were in the commercial, and this has really been shaping up to be something in the offices. And of course, you can look back and say, well, we should have known that because we had the work from home where you don't need all this office space. Now, we're talking about big mega offices, but in marketplaces where like Phoenix and Florida and Texas, a lot of these smaller places, like in Scottsdale, Arizona, it's very, very difficult to find an office location between 1,000 and 5,000 square feet. That's just where people are coming from. So they're leaving California and opening businesses here, and they need office space to do that. But they don't need the big mega warehouses. However, conversely, on the industrial end, along here in Phoenix, Arizona, along our 303, where we have all that growth, the big 1 million square foot properties are growing. So it does go from market to market as to where this is at. Now, San Francisco is certainly a problem. San Francisco is just at risk. Now, Westfield Mall and Westfield malls are a very big concern. They are going to let this mall in San Francisco go. They're citing crime and unsafe conditions for both their customers and their staff. They're concerned for the business. Nordstrom's has left, and they're going to default on $558 million. Now, let me go to my next slide. And we've just talked about this 2 weeks ago. Park Hotels is defaulting on 2 properties for a total of $725 million. That's over $1 billion. We're at $1.25 billion. But look at all the business that's coming out here. These 2 properties controlled about 3,000 hotel rooms, and they're leaving that marketplace. This is going to be devastating for San Francisco. So if you've got property in San Francisco or the surrounding areas, you have to ask yourself, what are you doing? Why are you doing this? You know, you're in a at-risk communities. So this is something we call an endangered city, and this is just going right along with our theory. You know, you're starting to see a collapse. Now, just think what happens when you're not going to get conventions there. They're going to be slowing down because you have people are concerned about crime and homelessness. You know, you're losing your hotel base. Now you're losing some of your retail base. You have to know that your tax base is going to go up. So why aren't you starting to think of maybe I want to do a 1031 exchange and move my properties and my investment properties away from this market into Florida, Texas, or Arizona? I mean, Arizona is right next door to you. The growth here is phenomenal. So we are not going to be immune from a cycle completion, but I cannot imagine that we're going to have, this is not going to be a 2008 here in Phoenix. we're certainly going to have some kind of a concern, but recovery will be quicker. We're not going to go down as bad, and recovery will be a lot faster. So highly recommend that you do that. And speaking of recommend, if you like our videos, would you please subscribe? We're not going to send you anything. It helps with our marketing. Give me a thumbs up if you like these. So where was I? Let me get back to my next slide here. So not only are these park defaulting, but PIMCO's Columbia defaulted on 7 properties for a total of $1.7 billion. So $1.7 billion, that's 7 1/4 and 550. Now we're talking some serious money, and someone is on the hook for that money. We've been talking about how banks are been in kind of a trouble. Not that they're illiquid, or not that they're in default, but they're illiquid. They're losing their cash basis. And we're going to have someone is going to be paying $3 billion for something they didn't want. They're in the lending business. They're not in the retail and office space business, and they're getting these properties back, and they're going to take a loss. So I don't think we're at the end of the banking crisis. So it's coming. But it's going to affect absolutely everything. And I think our concern is it's going to be centered really in a lot of commercial space. So here's what's happening in my business is that we're seeing that the requirement for getting a mortgage, and of course this can bleed into the commercial as well, it's the highest income requirements ever. Now, this removes a lot of people from the marketplace. If you haven't got enough income according to the underwriters, you can't get the loan. You can't get the loan, you're not going to buy the property. You can't buy the property. What it can be, someone's going to want to buy it. They're going to have to bring the price down till you get someone who can do this. And of course, that means what's the price of something that no one wants or no one can buy? So things you start to slow down quite a bit. And we're starting to see this across even in the housing. So we're also seeing underwriting respect. Let me go to my next slide here. Now, when we start talking about mortgage rates, we just got this last week. We had one of our investors want to buy just a small condo for an investment. It wasn't a big deal. It was like a $350,000 unit. He got quoted 8%. We also had a home buyer turn down. They had a 706 credit score, and the underwriter said, "No, we want a 720." So they're raising interest rates, tightening underwriting. That's going to slow the economy. It's going to slow the transactions. And as the transaction starts slowing, you're going to see less and less transaction. Of course, that impacts all the lenders. It impacts the appraisers, the home inspector people, the repair people, the title people, real estate people. This all impacts the business, and that is a downward spiral it affects their spending. And so this is a downdraft on the economy, and you can just see it. It's just coming. So this is what my timing model say. I've checked it and rechecked it. I looked at it. It looks like we're going to get to the final peak 3rd quarter of 2023, and that's within 90 days. We're talking about something we're going to know pretty quickly. Now, I'm not saying it's going to collapse from there. It's just that it's not going to go up anymore. It's going to probably correct from that. Now, I don't think this is going to be a 2008. I don't see that as a major problem. I don't see that happening. When to start talking about Seattle or Chicago or St. Louis, Portland, could this Boise, Idaho? Yeah, they could experience that because people are leaving those areas. New York has experienced this. So any of these places that have populations that's leaving, well, it kind of leaves a vacuum. Where there's a vacuum, there's, again, less demand, and prices will tend to come down. And that's where we get with the correction on this. And I think we are fully valued, and I think that we are really, within 90 days, probably going to reach our peak. So let me just go to my next slide. Now, we've seen this from Charles Hugh Smith did a great job talking about bubble symmetry. And, of course, we are certainly in a bubble. We're in the everything bubble. Every asset class has really bubbled. And he's talking about a retracement. I agree with him. I think we could easily have a 30 or 35% retracement. Now, again, it's going to be regional. Could it be 60%? Yeah, some of these tough markets could go 60% in Chicago or Portland. Yeah. What's going to prevent it? Now, if demand continues, so people continue to move to Portland, well, I think that's going to lessen any shock because, it's a demographic push. So people in Florida, Texas, and Arizona, they certainly are getting a benefit of a demographic shift. So they're just a great place to invest. They have long-term prospects. Here in Phoenix, Arizona, it's just off the charts. Are we going to get a correction? Probably. I don't think it's going to be that severe, but that correction is going to give an opportunity to buy really good homes at a lower price. But there will be an entry level in it, but it's not quite yet. So here's what we're going to recommend to all of our clients, and what I am doing personally. I am reviewing my exposure to equities. I want to see whatever equities I own. I want to see what the exposure is, what the downside potential for them is, what the upside. Not all equities are going to go down. I want to take a look at bonds and bond equivalent exposure. You know, if they're long term and rates go up, am I in trouble on this? What about, is there a trade possibility on this? Maybe we can buy some bonds and do a trade. I want to certainly review my expenses. I want to make sure I'm bidding out, particularly insurance and management and maintenance costs. If you're going to do any kind of improvements, you want to make sure you bid. I think there's going to be less and less pressure on the trades as business slows down. And I'm going to tell you, I'm going to look at my income streams. Take a look at where your cash is coming from. How secure is it? And include that in your rentals. How good are our tenants? We here in my portfolio, we have been concentrating on tenant quality. So the theme here is maximize tenant, not maximize rent. So we're willing to give 25 or 50 bucks away on a rental just to get a better tenant. So we certainly want to reduce debt. We want to sell marginal assets. And let me tell you, if you've got an asset that you want to sell, you better get on a stick and get it done, because I don't think you got much time. I think we're good until probably August or September. So that means in the residential real estate market, going to have a good summer selling season. But after that, I think things get to be, I think we're already in a recession personally. I just think, you know, it starts slow and then it starts going fast. And I think it's going to become very recognizable when we start getting into the third quarter. And that's where the red flag is going to be, and people are going to start getting a little bit of turmoil. And so you don't have a lot of time. If you're going to sell your properties, you need to get that done and get it done now. U.S. dollar is obviously under attack. You know, we have all kinds of global problems. They want the U.S. dollar. If the U.S. dollar goes down, I'm going to tell you right now, we'll go the way of Turkey. You know, Turkey's got terrible inflation because their dollar's terrible. Their lira doesn't buy anything. If the purchasing power of the U.S. dollar goes down, you know, we are going to have inflation. And if we have inflation, we're going to want to have tangible assets. One of the best tangible assets they have, again, is single family homes that we can rent, because they will track in inflation. But if interest rates go up, you know, there's a formula. We have to make sure we make money on it. But I would expect that somewhere along the line, we're going to see inflation and these assets are going to go up. Gives you a great buying opportunity, but there will be an entry level. And I'm going to tell you that severe recessions result in a policy response. The policy response has always been flooding the economy with cash. So if you get inflation and you get a fiscal stimulus, it's going to be very, very good for any real assets. I would be prepared for reduced liquidity. I think if commercial properties, you know, commercial properties are typically a 5-year mortgage. So if they're a 5-year mortgage, that means they're going to have to be refinanced. And I understand we have trillions of dollars that are going to be refinanced. This is the other side of this fact when we expect when the third quarter, we're going to start seeing these things where you start seeing more and more defaults because people can't get them refinanced. They give them back to the bank. You know, give them back to the bank destabilizes the bank. Very bad thing for this. So when you have reduced liquidity, it certainly affects more so commercial, industrial, building projects are all affected. Certainly some housing, because they're going to raise the underwriting requirements. Very, very good for us as investors. Our rental portfolios generally perform very, very well because there's no one buying homes. They're all renting, which is really good for us. I would expect, because of all this destabilization that is possible, that we're going to have bank failures. And I would say you're going to see that with bank defaults and bank runs. So I would protect my deposits, you know, make sure that, you know, review that with your financial advisor again as to where are you with your cash? Where's it being held? How's it being held? Maybe you want to move some of this to short-term treasuries, you know, 30, 60, 90-day treasuries. Talk to your financial guy. He can help you with that. And here's what I'm going to tell you. If you decide to keep a property, you are going to keep that for 3 to 5 years. And I would prepare for turbulence of 2 to 3 years. So that means to make sure you got additional cash at home. Having some extra food and water is certainly not a bad thing to do. So be prepared. Just mentally be prepared that things are going to get bad, but then they're going to get better. None of this stuff ever lasts. If we go into a recession, we'll come out of a recession, and that will afford us a absolutely outstanding opportunity to better our portfolios. If your 401k needs a little help, or your IRA, these are going to give you great opportunities with which to achieve some really good gains. But it's a timing thing. So in the meantime, we need to be conservative, and we will certainly get an opportunity to buy some things. Now, this is how you get a hold of me. If you want to schedule a call, I'll certainly talk to you and your spouse and your financial advisor, your CPA, whoever you want. We'll put our heads together, come up with a really good plan that's going to work. So in the meantime, my very, very best to you. Bye-bye now.